G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. People, we've heard you and you've said, look, get us an accountant who loves property and knows everything about tax. And we've heard you and we've actioned that as well. So today we've brought to the show Nick Fowell from Carnegie. Welcome on, mate. How you doing?
Thanks for having me. Going great. Excited.
Excellent, mate. In terms of accountants being rock stars, mate, you're right up there. We're at the Australian Property South Summit, and let me just say, groupies galore when it came to tax.
It took a while to get out of the venue. It was it's pretty hard to make tax interesting, but I guess we achieved it.
Mate, you did a pretty good job. Pretty good job. So as every investor knows, what makes or breaks is not only your ability to borrow and scale up a portfolio, but it's getting the right team around you, which is buyer's agent, an accountant, and mortgage broker as well, all singing from the same hymn sheet, which sometimes doesn't happen. Sometimes you throw a financial planner in the mix, friends, family, and now we're talking about 7 or 8 sets of conflicting opinions.
Friends and family, always.
Uh-huh.
Always.
Absolutely. Everyone's got an opinion, right?
Exactly.
So yeah, let's unpack that a little bit. What we want to do is take you on a journey. So if you're new to investing and you go, right, how do I make sure I get myself up and avoid some of those pitfalls that may come along your journey? Awesome. If you're more an experienced and astute investor, you're going, right, how do I then set my portfolio and my team up for growth? Then this is an episode for you as well. So strap yourself in, get pen and paper handy because there's going to be some gold that comes out of Nick's mouth as well. And Nick, before we kick off, just a little about yourself personally and professionally and your own property journey and what you care for. Happy to divulge.
So I started out as an accountant because my dad made me. That's a joke.
Apple doesn't fall far from the tree, does it?
That's a joke. He said to do exactly the opposite, but here I am. So I've been an accountant for about 15 years now.
Yeah.
So I worked at a mid-tier firm initially out of uni. Eventually, Dad said, I'm over this, come back.
Right.
So came back. And then from there, it's been great. He's got his clients. I've got my clients. We've grown really rapidly, which has been great and also tricky to work out the pitfalls. We're advising on businesses, but do your own business as well. But something that's always been in the background is property. Knowing that, normally it's not your business that makes you rich and able to retire early. It's the profits that you use from the business to be able to go purchase assets, purchase investments that create that extra income for you. When you sleep, the old saying, when you're sleeping, you're making money. That's always been an interest for me. So we've been pretty aggressively purchasing over the last few years, and long may that continue.
Well done. Yeah, I think it's one thing when you have advisors, but when they put their money where their mouth is, and you're walking that journey alongside
100%.
investors, so you know exactly what mistakes to avoid. You've been there, done that. So when there's real skin in the game, I find that really goes a long way, doesn't it?
It's something we say to every new client or any property discussion we have is, we've got I'm happy to say, a pretty significant portfolio ourselves. Anything we tell you to do is something we've done ourselves before multiple times. And because we've got so many property clients as well, I don't think there's anything that's possible out there that we haven't seen. There's obviously tricky scenarios and situations, like maybe someone's overseas or something like that. But we've dealt with it hundreds of times before. So it's the same in business. Why would you listen to an accountant who hasn't built a successful business themselves? Property, why would you listen to someone who hasn't done it themselves before? They haven't seen the pitfalls, the traps, the errors, because errors do happen.
Yeah, nice. That's something that I say a lot, which is when you're looking at an advisor or any type of professional, the 3 E's, bit of experience, bit of empathy, and some education that comes along the way as well.
Yeah,
so
I might steal that one.
There you go. Take that. That's free. I want to get straight into it. We are in a very fortunate position that we get to see all sorts of investors, the good, the bad, the ugly, the great, right? And when you look back, what are some of the hallmarks that you see that make incredible investors? I'm talking, say, top 1%ers.
Yep.
What are they doing exceptionally well?
So the first thing mainly is consistency. So not letting their life get in the way of continuing to purchase investments. So we all get busy. We've got family, friends, like you said, consistently reviewing your portfolio and consistently looking to grow it. So what a lot of people do is buy property and set and forget, and that's it, and well done, we bought one. The top 1% guys are continually looking at their portfolio, continually talking to their broker, going, how much is my servicing? So that when an opportunity comes up, they go, bang, yeah, we're ready to go. The ones who, they might be okay, they're not going to get to that 1%. They haven't talked to their broker. They haven't talked to their accountant about the structure. Have they got a trust ready to go? What is the right structure? The guys who are at the top 1% are continually consistent and continually organised with the 3 people: buyer's agent, accountant, broker.
Yeah.
Financial planner, may come into that. But that's more if you're moving into the SMSS space.
Yeah, okay. Great. And then on the flip side, when you go, people that had really good intentions, I said at the start, they've probably got the ability, the means, in terms of they've got the equity, they've got the borrowing capacity, And they've got at the start a bit of that fervor, and then somewhere
Dies
along the
off,
way
yeah.
it
It just
dies
dies
off. And
off, yeah.
and, I'll call them and go, "How's it going? Look, we're just gonna take a break for a little bit." And so naturally, I don't want to be pushy because I don't want to push someone into
Yeah.
it. They got to want it as well. But what do you see that tends where they fall off the wagon a bit?
It's interesting. I've actually gone back and looked at it, and it's normally around the 4 property mark that people sort of start to fall off. And at first I thought it was, they're satisfied with where it's up to.
Yeah.
But I think a lot of it actually comes down to they're not organised enough to keep going from that 4 plus. There's this mark where 4 becomes, there's things to do. You got to get bank accounts, you got to get agent statements and pay these things and whatnot. And normally at about 4, the excitement and the fervour, like you said, dies off and becomes a chore. We're not doing this to be exciting. We're doing this to build wealth. So just because the fervour dies off and the oh wow, we're buying another property becomes, I suppose, less exciting. We're not doing it for excitement. We're doing it to replace income and build wealth. So it's the people who treat it like that and treat it like work that be able to build those portfolios to 4 plus to 10 plus to 20 plus.
Yeah, right. Yeah, that probably surprises a lot of people when you start talking like 1% of investors are 6 plus properties, and you're saying say 10, 20, for example, and they're going, it seems almost a little bit unattainable for them, like their mind to get their wrap their head around. How are people scaling up?
And that's what I'm talking about with the consistency. It's not looking at, I'm going to get to 20. It's a pet hate when people go, oh, I want to get to 10 properties. You go, 10 what? 10 $300,000 properties, 10 $1 million properties, 10 resi, 10 commercial. A lot of them just want to go to the barbecue and brag they got 10 properties, right?
Absolutely.
What it's got to be is I want to replace X amount of income. So I need $100,000 a year to live. I want to replace that. And that's the people who get there just doing it one at a time. Yeah. So they consistently plan with their broker. Okay, I bought this one, next one. We're not looking at next 4, not looking at next 10. That's people who've got huge amounts of servicing, the very, very rare.
Yeah.
So the people who've got, just one after another, like I said, with that consistency, is not looking, I'm not saying don't plan, but not looking too far ahead and seeing, I've got 2, 10's unattainable. Okay, let's get to 3. Let's get to 4.
Damien says that a lot in our business because when we go do the property plan and kind of match that up with their lending and borrowing capacity for the future, he's telling me, he's like, mate, just calm it down a little bit because you don't know after 3 properties, their life may change as well. Things may change. Baby comes in the way, and then it's like, right, everything gets thrown out a little bit. So it's like it's too hard to predict after we do that first 3 or 4 and go, right,
correct.
We can get them to there, but we don't know at what point they're going to pull the trigger next, for example, and you go, right.
And that's what I say about that consistent chat with your broker, consistent chat with your accountant. Like what we do is, talk to your broker about, cool, this one's happening, but what about the one after? Because if we're purchasing this one and then you're dead in the water after, we need to know. Because we go, okay, can we use alternative structures to be able to keep purchasing? It's all just about the one after the next one. And what we always do with our clients as well is call us before you buy the property. Like just a quick 15-minute phone call, send it to us. We'll have a look at, we won't tell you if it's good or bad or not our job. It's the buyer's agent's job. That's why they get the big bucks, right? But we'll tell you, the land size. Is it going to affect your land tax? Is it fairly new? Should you get a depreciation schedule? If you're having those conversations, you won't get stuck. You won't get stuck. Like you said, oh, I'm having a baby, by the way. Okay, tell the broker that so they can work that into the servicing moving forward.
Absolutely. You just touched on land tax, which is one of the big questions I had for you.
Yeah.
People then dictate where they're going to buy and what they're going to buy. There's all sorts of taxes when you're a property. I think I was reading about like Victoria and all the new taxes they've put out that are affecting on property investors and why it's becoming a bit of a red zone at the moment, or what it's dubbed to be as well. And it's interesting because that's one of the more topical questions that people have, which is how do I avoid some of these taxes? Stamp duties are given, but capital gains tax, land tax, for example, and they're effectively trying to sidestep the taxes. But when you spoke, and I've heard it before, tax is a success fee.
Yeah,
I love the way that you phrase that as well. So take us through like the land tax, I guess, in a nutshell, kind of state by state, if you can. And then off the back of that, we'll then talk about what you mentioned before, which is structures, which is how to get smart and intelligent about what type of properties you're buying in structures.
So, when we say tax is a success fee, it's also, that doesn't mean we just slap you with a tax return or a land tax bill and go, ha, you won. See you next year. Obviously, if we can avoid land tax, we want to avoid it. But the thing you got to remember is land tax is tax deductible. Secondly, it's unavoidable at some point anyway. If you're in the property market, you obviously think the property market is going up. So if the property market is going up, your properties are going up, and they will go over thresholds. The other thing you got to remember is it's the most likely to change. State governments have got big deficits. We look at New South Wales now with the GST at the time of this recording. having 13 billion, I think the number was, taken out of their coffers. What's one of the easiest ways for the governments to refill those coffers? Rich property investors. So land tax is the most subject to change. So when we look at our structures and we effectively try and determine what's going to minimise it, I always put it as the least important factor. Is it a factor? Absolutely, it's a factor. We want to avoid it if we can. But if you've got a cracking property in Queensland and one that's okay in WA, and you're like, oh, but I want to avoid the Queensland land tax, like the land tax is probably a couple of grand a year. The equity uplift from the cracking property versus the average one in WA where you avoid land tax, it just doesn't make sense. So it's something where when we're planning portfolios, we go, okay, is it a factor? Yes. Can we use a structure to avoid it? We will. But it absolutely should not determine your choice between two different properties. It is a tax-deductible tax, effectively, and it's unavoidable at some point anyway. So if you're looking to avoid it for 3 years and you make a decision on a property that's going to have a better land tax outcome, then in 3 years you go over anyway, and you own the property for 20 more years, well, what have you just done? So it's something where you got to make sure your accountant knows the land tax thresholds in every state, because every state's different. So one, give them a quick test, like, what's the land tax threshold for trust in WA? 300 grand. If they don't know that off the top of their head, maybe they're not the accountant for you, because they are quite easy to remember. But it's something where, like I said, it's a factor. Do we want to avoid it? Yes, but bottom of the queue for me.
Yeah, nice one. And then I guess when we talk about structures, so again, people really trying to go, okay, I'm going to double down on like buying through trusts or companies, and you're like, okay, take me through why. And there's not a really great conviction as to why they're buying it. They just think it's the buzzword.
100%.
When do you think is the right time for people to start bringing entities in, like a trust, for example, and different types of trusts there, compared to individual name?
Yeah. So like, we'll just ignore unit trust for the time being. But in terms of purchasing individually versus a discretionary / family trust, and they are effectively the same thing. What we do is we assess asset protection, income tax, and land tax in order for each client. What's most important to you? Because that will determine the structure. So someone who's running a building company, for example, reasonably risky, asset protection is number one. For them, we'll go straight into a trust. The trust protects your assets. Something happens to you personally, then effectively the asset is protected. Someone who's on PAYG withholding, and they're going to be on PAYG withholding the rest of their life, fantastic. We don't need that asset protection element. So it comes down the queue in order of importance. Second element, income tax. So if we got a wife earning 250 grand and a husband earning 100, we'll go, great, a trust will work quite nicely because we can distribute all the profit to the husband on the lower tax rate. Vice versa, if you got someone, both husband and wife or partner and partner are earning 100 grand each and they have no one in Australia to distribute profit to, trusts aren't that effective from an income tax perspective, so it come down the bottom of the queue. And then finally, land tax is effectively, do you have multiple properties in Queensland already? Do we want to then avoid it and go into a trust from there? So every time we buy a property, we go through those three factors. And the reason we go through those three factors, one, at the start of the engagement, but two, when a property is found, is, like you said, situations change. We're having a kid now. We're moving overseas. Our borrowing power is not where it used to be. If that's the case, then maybe we want to go into a trust so we can ring fence that debt with a corporate trustee. So it's important that you have that conversation with your accountant, asset protection, income tax, land tax. But as you know, the one overarching factor is borrowing. If the lender or the broker has said, look, we have to go in, the decision is made for us. So we go through that on the start of an engagement, and then every time a property is found, that's how we won't make a mistake. If we just say, Aaron, yeah, next one's going into a trust, and you go, sweet, Nick said next one's going into a trust, and it's in New South Wales, where the land tax threshold is nil for discretionary and family trusts, we've just cost you a lot of money per year.
Yeah. Yeah, I think it's one of the analogies that I use is measure twice, cut once when it comes to getting it set up, because once you start to get the ball rolling, start buying through those entities, it's unintended consequences, which it might rear its ugly head come tax time.
Exactly.
No idea. Or when it's when you're still losing and you're negatively geared on that trust property, it's like it still comes into the equation. So until it's kind of washing its face.
Like I said, that's why we want to reassess when we're buying the property. Is say it's a 5-year-old property in Queensland. It's got a hell of a lot of depreciation left on it. And we go, oh, we want a bit of asset protection elements. We put in the trust. But now it's quarantined in their losses of, 10, 20 grand a year. You're annoyed because we can't write a letter saying it's trading profitably and we're stuck. So that's why it's important we have to go through it every single time.
Yeah, beautiful. And then we have clients that are buying 99.1. So for those that are listening that don't understand, it's when you use ownership. You're changing the percentage of ownership on the title of the property. And so we're using 99.1. They've been advised that, for example. So when is that like relevant or pertinent for someone?
100% of the time, asset protection normally.
Yeah.
So what it normally is one of the two in the relationship is risky. So they want to put 99% in the wife's name. This is exactly what I did, by the way. So my wife's doing really well, not me as much.
On paper, you're a pauper.
Yeah, she's going fantastic. So 99%'s in her name, 1%'s in my name. Why the 1%? Well, it means that the property can't be sold without you obviously signing off on anything. In a disaster scenario where you need to effectively liquidate, well, you only have to liquidate the 1% to your partner. So it's a really strong asset protection play, really strong. Obviously, you got to make sure that works with the broker as well. If you throw that at them, as I'm sure you've had in the last second, oh, by the way, 99% of my partner's name. I'm like, oh, great, I've got to go back to the bank now.
Absolutely. And not all banks love it as well.
No.
That's the other challenge, right? They want to have some minimum percentage or skin in the game as well. So that does strike out certain banks. The other one's really gaining a lot of traction as people run out of borrowing capacity, saying their individual names is self-managed super funds, which has its time and place as well.
Yeah.
When clients are coming to you saying, look, we're really excited, we're going to go through an SMSF, again, what do they need to know about before they pull the trigger?
So it's super important on the SMSFs that you speak to a financial planner. You have to speak to them beforehand. They may say no, they may say yes, but you got to do yourself that favor effectively to go, I've approached a professional and got that advice. And the other thing that we push people to is the broker. There's no point us setting up an SMSF and charging the money and then effectively preparing a bear trust, and then the broker says you guys can't borrow money in your SMSF. We always want to have that conversation with the broker beforehand so that when it's ready to go, we go, great, we know that we can move forward in this thing. And the client knows exactly, okay, I've got $400,000 worth of servicing capacity. I know exactly what I can buy. That way you're not walking in, spending money, rolling all your money into your industry fund and going, oh, can't do anything.
Spot on. Perfect. One of the things I loved hearing you talk about as we come to the end of the financial year, which is the ATO, and it has its sights set firm. And I've seen this come up a couple of times over the last few years, which is, they've got their laser focus on property investors. I think the stat was 9 out of 10 investors will have some either they made a mistake, an innocent mistake, or there's a false claim in there, and so they're really kind of doubling down on stamping that out. So can you tell us, like, what are they looking for? What are the red flags that pop up?
The main thing they're looking for in terms of what we've heard from them, and we always have constant communication to find out what they're looking for, is repairs and maintenance. Okay. And the big thing with that is a lot of agents will say you put a new dishwasher in and it's $500. The agent won't necessarily advise you on that. They'll just put it repairs and maintenance, put it in your year-end statement, and that's it. Technically, that's a capital asset. Anything over $300 that is a replacement or improvement must be depreciated. So the error that we normally see the most is the agents put in a new fridge, new dishwasher, like I said, and they put in repairs and maintenance. You give it to the accountant, and the accountant puts it in repairs and maintenance, and the ATO go, ding, something over $300. Is that an improvement or a replacement? That should have been depreciated. That's absolutely the main thing we see. And just for everyone's knowledge as to what's a replacement, what's an improvement, if you're repairing something to its previous state, that is a repairs and maintenance. So effectively, if there's patched up painting and it's looking a bit rubbish and you just return it to its normal state, that's a repair. If you completely do a repaint, that's an improvement, and that has to be depreciated. And you've got to be careful with these things like painting and carpets and all that. They're depreciated over long periods of time, 10, 20 years. So you may spend $20,000 worth of painting in June thinking, oh, I'm going to get a tax deduction for $20,000. And the accountant comes and goes, here's your $200 tax deduction because it's depreciated over a long period of time. So before you do any big works on your property, or before the agent goes, oh, we need to repair this, just give me the approval, speak to the accountant, is this going to be an improvement, or is this going to be a replacement, or is this going to be repairs? Because that, like I said, we see people get called out all the time without checking $20,000 kitchen reno, thinking it can be depreciated in full. Yeah. Unfortunately not.
And then I guess it's in the heat of the moment because the tenants then reached out to the property manager, hey, we need this replaced.
Hurry up.
And then you're like, I don't want to be doing the wrong thing by the tenant, so I'll push the button and say yes. And we said before, sometimes people don't hear from their accountant for some time, like, hey, where's your financials? And like, oh, I asked the accountant for about a month ago. I'm still waiting to hear back. I was like, as a broker, if I didn't get back to them within a day, I think you said that.
Freaking out.
Yeah, correct. If we don't get back to them within like a day or two, we're a hunted species. But
the other big one is interest. So especially like when we're doing equity strips and stripping down on equity to go buy another property, The ATO now data matched to lending organizations, to banks. They know now.
So take us through. Yeah, you just rolled that off the tongue. But for people that haven't heard that before, say that again if that's all right.
Equity strips.
Yeah, as in like, and how the ATO then data matches.
Yeah, perfect. So effectively, let's say we've got a $1 million property in our personal name.
Yeah.
The loan on it is $500,000.
Yeah.
And we go, great, we've got $500,000 worth of equity here. If we want to get up to an 80% LVR, we can pull down $300,000 against equity and then use that to buy a new investment property. That's deductible. That's fine. But it's deductible against the new property, not the property that you pull down the equity from. So if we've got multiple trusts, and this is the most common example we see of this is you got property in trust one, it's got a nice amount of equity, you go to the broker, you go, fantastic, give me that $300,000, and you go purchase in another trust. That $300,000 is claimable against the property in the other trust. So we've got to make sure we get that allocation of interest correct across individual names, across trusts, across whatever it may be. But the tax deductible purpose has to be in the right entity against the right property. And so the ATO now match against the lenders and banks and everything like that. They know the interest amounts and they know what it was used for as well. So they can effectively look at your returns and go, well, hang on, you've got, let's just say, property in your personal name this time that you pulled down a lot of money from, and you claimed it in your personal name because it suited you because that's where you get the tax deduction, but you actually use it to buy property in a trust. That's where the deduction should have been. And people go, well, I want to eat my personal name because my tax rate's higher. Too bad. It has to be against the property that was used for.
Yeah, which then almost brings up the point that you've got to be super, super organised.
Yeah.
With your paperwork. So, for example, like the trail, because we're doing loans here and we're shifting banks and refinancing, so loans get closed off, for example. And so your record keeping then needs to be kind of A1 and admin, which is probably where you mentioned about when you get to that 4 properties and now life admin kicks in and it's like that loan, those bank fees and that mortgage insurance rate. So this property, for example, which means your record keeping needs to be tip top.
100%. It's because what you'll see with a lot of accountants, I'm not here to diss the profession, is that they'll just get, give me a year-end interest statement. And you go, cool, here's your year-end interest statement. That doesn't list the equity strip in it or what you use it for. And the accountant goes, great, 15,000, puts it in. Could they have been a bit more diligent? Yes. But you need to let them know that as well, because if they're just grabbing the year-end statement and putting it in, from their eyes, it's correct. We need to make sure they're aware of these equity strips. So they know, okay, you pull down that money, that goes against that property there. It's a huge stress because, like I said, if you've got 5, 6, 7 properties or you've done 3, 4 equity strips in a year, it's quite a bit to organise. And you're probably going to pay the accountant more because there's a lot more to do. But it's really important. You don't want to be pinged by the ATO and be on their audit list.
Yeah. So if I'm growing my portfolio and I've done those equity strips throughout the year, how am I keeping my records up to date throughout the year that when it comes tax time, one, as the borrower and the investor, I'm in a good place, but two, the accountant then kind of has that information at his or her fingertips to go, I can see what you've done here and we're all speaking the same language.
Yeah. At bare minimum, you've got to have something like a Google Drive or a OneDrive with everything in it. Share it with the accountant. They may have a portal that you can share with them too. I do find, been doing this 15 years, if you send things to them throughout the year, they'll put it in their document storage system and then probably ask for it at year end anyway.
Yeah.
So it's
really that's the thing. Like you trawl through your emails and it says a bucketload of emails, or the filing or naming conventions that we have versus what a client has as well. It can be different. So record keeping becomes super, super pertinent. Sorry, keep going.
Yeah, no, I was just going to say, I like to keep a spreadsheet personally. So I've got a spreadsheet that I use that tracks ROI, return on debt as well, capital yield, et cetera, et cetera. All that stuff in that spreadsheet can help guide the accountant. So what we tell our clients to do is at minimum have a Google Drive with each property, all the info throughout the year, put in there. And then if you've got that equity strip document or that new loan document, put it in that property, the accountant can pick it up. That is the absolute bare minimum that you've got to do. You can go further and use apps or use Xero to effectively start tracking things. Obviously, that incurs extra costs, but if you're getting up to that 10 plus, you're probably going to have to do it anyway to save yourself time. But at bare minimum, you must be keeping some sort of drive and some sort of spreadsheet.
Cool. Do you have any suggestions on apps at all that you've seen that are pretty good?
Yeah, we use Xero personally. There is another one that we're testing out that hasn't come out to market yet. I'm pretty excited about.
All right.
I'll keep that one on the wraps for the time being.
Yeah.
But it's quite good. We like I manage my portfolio via Xero,
Mm-hmm.
and that's is it a bit more work? Yeah, it's a little bit more work. But at year end, all I've got to do is press print, and it's done.
Absolutely.
Literally done. So Xero works quite nicely in that you can have 50 properties. You can track all the different properties. You can also track it via trust. So because it's got two effectively abilities to track two different sets of data. So me with 6 different trusts and all the properties, I can track every transaction by trust and every transaction by property, meaning I can review the whole portfolio. I can review just the properties in Queensland, or if I need to do my trust tax return, let's go trust one, print.
Spoken like a true accountant, mate. I love it.
I don't have any tattoos, but if I did, it'd be Xero right here. So if they can hurry up and sponsor me, that'd be good.
On that, you mentioned spreadsheet. Is that something that people can get access to? For example, like where you have that type of data? Is it?
Yeah, so it's not nothing overly complicated, and effectively the spreadsheet is, like I said, lists the property, what you bought it for, what the equity is, what the loan is, and all the interest and repayments, things like that. So we got a pretty good one that we use. Yeah.
Okay. Well, I might try and see if we can.
Yeah.
Hit you up for that.
It's expensive.
It costs us a case of beer.
Yeah, half a case.
At a time like now where, let's say, for example, last few years where rates were super low and people cash flow positive on these bad boys and just going, look, I'm loving life, to now where I think I did one loan yesterday and the investor was like, that seems high. I'm like, 8%. I was like, yeah, that's because the borrowing capacity is where we can go. And I don't want to be tone deaf, and I mention this quite a lot of times to a lot of our listeners, which is investing in a higher interest rate time is it takes a little bit more gusto as well. So there are options for people if they're salaried, something like a PAYG variation. We mentioned that to a client; they're like, they had no idea.
It's barely known. Yeah,
it is. It's barely known. I'm surprised by it. So again, for those of the uninitiated that aren't aware of it. 101 on what a PAYG variation is.
So effectively, the end result of a PAYG variation is the ATO telling your employer to withhold less tax from your wage because you've got big deductions. So when we're referring to big deductions, we're referring to negatively geared properties. So if you got, like you said, an 8% property and it's got a depreciation schedule on it, and you're losing 10 to 15 grand on paper on your tax return every year, you get a big tax refund. Great, awesome, fantastic. It's like, but you're loaning the ATO money for free throughout the whole year. So what you can do is say you've got this like $20,000 loss because you've got $5,000 worth of car expenses, $15,000 worth of negative geared property. You can fill out a pay-as-you-go variation form, or your accountant can, and put those details in there. And say you're having tax withheld at 34.5%, they'll then work out, okay, no, your employer only has to withhold at 30%, which means you're getting paid more every week, every fortnight, every month from your employer. And when you get to year end to do your tax return, you should be fairly neutral, small payable, small refundable, because you've brought forward that cash into your pocket. And I'm assuming from your perspective that helps from a borrowing capacity as well, because the servicing's higher.
Helps from a borrowing capacity, but also helps from a headspace perspective, because most people are seeing the red between like the monthly repayment and then the rental income, and they're going, I just can't cover this gap. It's really going to hurt me. Plus they got maybe their mortgage and their living expenses, and that maybe is the straw that breaks the camel's back. Going, I just can't make this deal stack up because I'm going to have to cover this loss. I'm going, well, actually, there is a way to bridge this gap. So if I'm hearing this for the first time, what do I need to do next in order to get this ball rolling?
Yep.
On a PAYG variation, what do I need to do?
So they're not, I'm not going to say they're the easiest forms in the world. You can download it from the ATO website. I would always get an accountant to do it. No, I'm not reaching out for extra referrals or money.
Mate, this whole thing's not about this. We're not about farming or fishing for business here. It's about education. So go nuts.
It's something you don't want to get wrong. The reason you don't want to get wrong is if you get it wrong and you put your deductions in and you put your income in, because it's to be frank, it's a fairly archaic form. It hasn't been updated for years.
I'm thinking ATO form isn't exactly the most customer friendly.
Well, why would they make it customer friendly? They've got no competitors, right? So you got to fill in what you've earned for the year so far. You got to fill in what your estimated deductions will be. If you get that wrong, and I've seen someone fill out the form, and the ATO then sent to the employer withhold tax at 0%. Jeez. And this person was left with a $30,000 bill, and they didn't know. They thought they'd done it all right. They're not an accountant. Like, why would they think they've done it wrong? And we get halfway through the year. I'm like, give me a pay slip, and 0% tax withheld, and they're up for a huge tax bill. So if your account's charging you a couple of $100 to do it, it's worth it. If you're confident and you know and you're reading through the form and it all makes sense, absolutely. But I would at minimum get them just to do a once over of it before lodging it, especially if you're doing it at the start of the year. Because if you do it at the start of the year, you then got 12 months worth of errors. And I guess the year-end tax return and your accountant goes, here's your $40,000 tax bill. You're like, wow, okay, I need another loan to pay the tax bill.
And you don't generally get top-up loans to pay a tax bill.
No, the ATO charge you interest as soon as it becomes due. So the other big thing we see in there is HEX. People don't put their HEX in. And HEX repayments are still taxed on your taxable income. And it's something where you got your tax, so say 32.5% and 8% income tax, HEX repayment, you're over 40. And if you get that wrong, it can really sting.
Absolutely. Yeah, unintended consequences is what I usually call this.
Yeah.
You had the right intention, the execution went a little bit off, and then suddenly you're kicking the can down the road from a tax perspective.
Yeah, exactly. I mean, it can go the opposite way as well. The ATO, you don't fill it out enough, and then they need to change it by 2.5%. Then you're still getting a big refund at year end. Which again, my whole thing is if you're getting a big refund at year end, some people like it because it's like forced savings. But if we think about it dollar for dollar wise, you are literally giving an interest-free loan to the government, quite literally. So if you can vary that, so you're getting it in your pocket every week, obviously legally and all above board, why wouldn't you?
Yeah, I mean, if we look at it as a business, we speak about investing probably like a business. There's no way that you and I would run our business close to the bone to try and get something after 30 June. Yeah. Like a sugar hit, I'm going, mate, give me the cash now because I could probably do better with it than what the ATO could do.
Yeah, I mean, not to touch too much on businesses, but the same businesses have to prepay tax. If we lodge BAS statements and prepay tax and then the client gets a big refund at year end, we haven't done our job. We've just forced you to give the ATO a loan. So like you said, treating it like a business, keep that cash in your pocket. It's better in yours than theirs.
Yeah. One of the big questions we get when people look at buyer's agents is the buyer's agent's fee tax deductible?
No. No. It effectively forms part of the cost base of the property. So effectively you get a deduction when you sell the property. It's a really tricky space, this whole buyer's agents and courses and things like that, because everyone spends a lot of money on these courses, for example, and they're not entirely tax deductible. The bit that is deductible is the bit that is related to improving your rent received. So things like, how do I get a better agent? How do I get better rent returns? Anything that increases your, or potentially can increase your income is deductible. So when you go do these courses and like, I say it's, $20,000, I've seen people go to London for $20,000 for a course, but it's related to building a portfolio. That part's not deductible. And even for the part that is related to increasing rent, you've got to have a portfolio already. So with these courses, is one, speak to the person who's running the course, what part's deductible. To confirm it with the accountant beforehand, because they're the one that's going to sign off on it at the end of the day. So like when we, I suppose, see people do these courses, we want to have as much of it relating to increasing income. And you've got to have a portfolio already to be deductible.
What defines a portfolio? One property?
One property.
Perfect.
One property. So as long as you're receiving rental income and you're doing a course that relates to increasing that rental income, that's deductible.
What about travel to this course?
Yeah, so the travel to the course does form part of the deductibility. If you're going to, like I said, London, and then having a week holiday after, not deductible, you got to apportion it.
Yeah, okay, great. What about travel to the investment property? I understand that ship has sailed.
Gone. So you used to be able to claim travel to invest, to see it, to do repairs and maintenance, do strata meetings. That's all gone, everything. You can claim like bits of phone and internet in relation to managing the portfolio. But if we're all being honest with ourselves, that's probably a couple of dollars here and there. I don't know how many times you're calling your real estate agent, but I'm not calling. I'm avoiding the calls if I can.
Yeah, because something's going wrong at the property.
Yeah, exactly.
Possibly.
The plumbing's going wrong. Oh gosh, I have to pay more money.
Absolutely. The other one I've got here is end of financial year. So again, this whole notion of like what makes a great client, great investor, for example. Changing accountants, again, we're not farming or fishing for business here, but what questions should be people asking if they're accountant to know either at start or as they're growing in their journey to go, this is the right partner for my growth?
So a big one is, when can I get my tax return done? Because obviously you guys are going to need it, right? Like brokers are going to need it nice and early. So when can you fit me in? And then two, is there anything I should do before the end of the year? And what that is like, have a look at the properties I bought this year. Should I get a depreciation schedule done? You can get that done after the end of the year, but just remember the cost of the schedule is deductible. So you want to do it before the end of the year. in terms of having a look at the portfolio, is there anything else that you recommend I do before year end, like prepay some interest? Prepaying interest is tax deductible on properties to bring forward that deduction. And then finally, and like our email just went out about this, and it's my favorite thing to do is tax planning. Tax planning is very, very important. It's like if you try and go to your accountant after the end of the year and go, all right, what can we do to minimize my tax? It's shutting the gate after the horse is bolted. There is almost nothing you can do. You can go get a depreciation schedule after the fact, but that's it. If you do tax planning with your accountant ahead of time and go, cool, what is my tax going to be? They'll tell you exactly what it is. So one, you've got pre-warning on what you're going to pay. Number two, they should be giving you strategies. They're not going to tell you to contribute to super, but you can contribute to super if you want to. This is how much you can catch up. So if your super balance is under 500,000 and you haven't maxed out in the last couple of years, they can download a report from the tax office and you can contribute extra. Your land tax bill hasn't been paid. Pay that before the end of the year because it's not deductible until it's paid. Doing that tax planning ahead of time, yes, again, you'll pay a fee, but I know guarantee you're going to save tax.
Yeah, thanks very much. Just want to change tack a little bit and talk about people that are self-employed. So business owners, for example, and again, we have a chat to a lot of business owners that are looking to invest heavily in their business, and we're saying, look, could you or should you be thinking about investing in property, that there's income-producing assets that make money while you sleep, and they kind of double down their business. And at some point, business owners either get a little bit tired, they lose a little bit of passion or love for their business, and I kind of see that at different cycles. A 7-year itch, for example, or maybe chase a shiny object or start to diversify their business.
I've hit that personally, so yeah.
Oh, mate, we've all been there. I think I've done so well. I think I'm going to start to do something else and add an extra string to my bow. And even us, we've been very open that we bought a commercial property, and even that has its own unintended consequences around how much cash that takes, how much time that takes out of our core business and our focus as well. But again, I want to come back to this point that self-employed people are no different to, when I say self-employed, they're effectively owner-operators, right? So they're trading their time for money versus having assets, one, that do heavy lift in terms of its growth and uplift, and then two, cash flow as well, which means, de-risks, having to put all your energy and effort into growing and scaling your business. So when you're having that conversation, where do a lot of your self-employed clients sit on the scale of, say, property investors or doubling down on their own business?
Yeah, I would say most double down on their own business because they feel like they've got more control over it, which is true, exactly correct, but to a degree as well. It's about pulling that money out of the company and making it work. In my opinion, cash is the most useless asset. When we work with businesses, we don't want to go in and go, oh, great, you got all this cash at bank, we're all safe. Cash doesn't work for you. The bank doesn't give you much interest for holding it there, do they? So we need to get that cash working. So while we want to have a mix between the property and the business, so yes, is there a lot of cash at bank in the business? Are we going to go acquire more assets like trucks so we can do more jobs, or go invest in more staff and pay recruiting fees? If the business is effectively traveling on nicely, we should set a cash buffer that this is the minimum amount that we need to have. Everything else should be drawn out and used for assets, in my opinion.
Yeah, this is a conversation I think that we're even having a lot more, which is, you might get tired, or you might get, regulation changes. I mean, we were speaking before, hospitality, construction, other industries that are kind of going through a tougher period, more challenging times. And challenging times either, has its people that step up and lean straight into those challenges and will shoot the lights out. Or people go, man, my back's to the wall, been working like an absolute donkey. I can't see any benefit for it. Yeah. And we're going, right, if you'd invested into property maybe 5 years ago versus your business, you'd be streets ahead from where you are. And it's only the benefit of hindsight that really gives them that perspective. So we're saying, look, why don't we have a healthy balance of invest in your property and double down, but also diversify, de-risk yourself, and have other income producing assets.
It's a safety net, because what a lot of people, especially like you mentioned the 7-year itch and whatnot, they see their revenue growing up and like, oh, good, I've just got to keep reinvesting in my business and the revenue will keep going up. But what you'll see is a curve where like effectively the revenue goes up, but the profit starts to plateau because you're more investing in more staff. You need the commercial property, you need more things, your net profit percentage goes down. And then all of a sudden you're working like a donkey and you're making the same amount of money. And if you hadn't pulled that money out to go buy property, you don't have the safety net. All you can do now is hopefully sell your business or try and keep going and fix it. So I call it a safety net because effectively it's, like I said, you pull the money out, it does its thing from there. cash flow deal, not bread and butter, sorry, capital growth deals, whatever it may be. I personally like cash flow deals because you got more control over it. No one knows if the market's going to go up. Hence why I like cash flow deals. But if you're pulling that money out of the company safely and not draining the company, so it's you got no money at bank, you're creating a safety net for yourself that if things go wrong, markets go down, and you're in hospitality and like we currently are right now, and it's a bit of a slog, you've got that safety net. You've got something there. You can sell the property if it's really bad. You can therefore have a capital gain and cover yourself up. But if you're not doing that, you're leaving yourself exposed.
And again, touching on self-employed, and we're blown away by it when we see the stats around ATO debt.
Yeah.
And business owners carrying around that much ATO debt. What does someone do if they've got an ATO debt and they're speaking to their accountant, but they feel like they're banging their head against a brick wall? And it's like a ball and chain, right? This thing will just follow you around everywhere, and it really kind of leaves you handcuffed to your business.
It does.
Even deeper.
I would ask if you're really feeling that ball and chain, speak to an accountant about an SBR, which is a small business restructure, which is an ATO program post-COVID to help business owners get out of debt. It's not a last resort scenario. Last resort is liquidation and administration, but small business restructures are really effective. The step before that would be, can we work out a 24-month cash flow plan? Because if you can work out a 24-month cash flow plan and go, yes, there is a light at the end of the tunnel, perfect. And you've at least got that 24 months to go work towards it. If it's just not possible and it's not working out, speak to the accountant about a small business restructure. It won't be around forever. Like I said, it's a COVID program, but it has allowed people to keep moving. So without getting too much into it, effectively what it is an administration expert will speak to your creditors and go, we can pay 10 cents on the dollar for all the debt, or 20 cents. I think the average at the moment is 22 cents. That plan is then accepted by the creditors, and then everyone moves on from there. It's like I said, not the last resort, it's the second last resort scenario, but it is really effective. Yeah,
I see a lot of similarities kind of coming through COVID, which was money was cheap.
Yep.
And handed out freely. So business owners got their bite of the cherry getting all those COVID loans, for example, and a lot of support. And then property investors got access to cheap money, which means they could go out and buy at peak in peak property markets as well. And now we've come to a real shift almost like 2 years later, and the tide has, like the pendulum swung the other way. The tide has turned. It's going, it seemed like a really good idea at the time to get access to the cheap money and credit. Now we've got to pay these things off, and market conditions have changed significantly.
Yep.
Are you having these conversations with people, and what's the sentiment like on the ground?
It's a complete 180 from 2 years ago. I mean, the initial rush during COVID, when like it first happened, we were doing JobKeeper and JobSaver and all this stuff, and while we're having not fun conversations as to what's in the future, businesses were okay. They were getting supplemented by the government. Property investors were okay because interest on debt was 1%. Like free money. It's quite literally free money. And then now we're having conversations now going, okay, look, the business is struggling. What plans can we put in place to counteract that? Do we need to trim staff? Do we need to trim costs? Or is it a matter of going and acquiring a new business so we can get more revenue? And much the same from property investors, and you would see it as well, as this struggle to get debt and this struggle for like us to write a letter saying things are trading profitably. Because interest rates are 7%, yield 6%, instantly you're not trading profitably, instantly. So it makes it very hard, and it's tricky because you have a lot of people who built portfolios over COVID and they go, oh, it's nice and easy. It is not easy now. I'm not sitting here and saying it's like, be consistent, keep buying every property every quarter. It is a lot harder than it is. So you need to allocate more time to it and more effectively conversations with your broker, with your accountant, with your buyer's agent, to get this thing moving, because it is a whole lot harder. It's absolutely doable. We're doing it. A lot of people are doing it. Yeah. But you got to put more effort into it.
That's exactly what we say. It's not hard, but it's also not easy at the same time. Yeah. Because it just takes a little bit of rolling your sleeves up and kind of, let's get some sweat equity going here about how do we build a portfolio. That means it's not quick and dirty. It's like, right, let's take our time. Let's get these numbers structured right. Let's not be in a rush to buy, but when the right opportunity comes up, you can kind of pull the trigger on this.
Yep.
And it's a slow down to speed up type type mentality that we're kind of building out there.
And because it's so hard, that like just back to the start where we said be organized, allocate. Like I know no one wants to work when they get home. I get it, trust me. But allocate the time, 2 hours on a weekend, 2 hours on a Thursday evening, whatever it may be, to be organized ahead of time for this next property because it is going to be tricky. It's not what it used to be. Doesn't mean it's impossible.
Yeah, I appreciate it. You'll hear me often say in our podcast, the property market rewards action takers and decision makers. That's one of our big mantras as well. But also that you will rise to the caliber of your team. So we see it all the time. If you're getting great advice, if your buyer's agent, broker, accountant is giving you the tools and the mindset to enable your growth, you will get there as well. And success leaves clues. So if you're looking for someone that's been there, done that from personal property investing journey, you've done that, Nick.
Yep.
From a professional services to property investors, you're doing that in spades as well. So I want to say thank you very much for coming on. I really appreciate your knowledge. Like you said, can we make tax sexy and interesting? Mission accomplished, mate. I think you've done pretty good.
It.
And like I said, Nick's not here to farm or fish for business, very much to educate and share his knowledge. But if you do want to reach out to the team at Carnegie, we'll include the details. We'll see if we can get a copy of that spreadsheet as well for people that want to grow their portfolios. And like I said, if you're at the start of your journey, you want to reach out and kind of have that property strategy roadmap session, if you're more an astute and experienced investor that you want to kind of grow and scale, let's pop the hood on your portfolio and do a bit of a strategy session to go, right, are we missing anything, or is there any equity or any ways that we can bump up borrowing capacity, i.e. a PAYG variation, so we're not leaving anything on the table for you. That's a wrap for another episode of the Australian Property Investment Podcast. If you think someone would love to check out this episode, share the link. That's the way that we're getting so much traction, is people kind of DMing us with some questions they've got or sharing episodes with a friend. And we just want that ripple effect to get us so much bigger and better so we can help more investors kind of hit that 1% mark as well. Thanks very much. We'll talk soon.